In the 21st century, it's not uncommon to have an uninformed investor and even a millionaire that's not aware of what they're holding in their portfolios. Most people, if asked, will start to list stocks and bonds of various types as if that's all you need to secure a great retirement. Little do people actually realize that they don't actually own stocks, they own electrons. Most wealth today is in digital form, recorded on hard drives and transferred through routers and servers in dispersed locations. What if those servers were hacked or your electronic wealth were erased? Where would you go to get it back? If you think this can't happen, guess again. SWIFT is a secure global messaging network used by banks and other financial institutions to send payments instructions. It became a vital part of the global monetary system, serving 11,000 banks, and it's been hacked, as has the safest bank in the world, the New York Federal Reserve. So the most secure financial message traffic system in the world and the safest bank in the world were both hacked, and 81 million disappeared into thin air. If it can happen to them, it can happen to you. The solution is to own physical gold. It's one asset that can't be hacked, erased, or made to disappear. That's not to say you should call up your broker and then tell them to sell all your stocks. Not at all. Stocks form an important part of a well-balanced portfolio, and Jim Rickards strongly recommends selecting gold stocks right now as an example. But you should also have physical gold as insurance. Shortly, I will show you why gold might be the best form of insurance you can buy. Your wealth is far more vulnerable than you think. How vulnerable? Just keep watching. Recently, Jim Rickards, best-selling author of several books including his latest, The Road to Ruin, The Global Elite's Secret Plan for the Next Financial Crisis, returned from Switzerland where he met with the head of the world's largest gold refinery. A refinery takes gold in one form, processes it, and sells it in different form, usually a more pure form. He told him he has a waiting list of customers. Those customers want to buy more gold than he can produce. He's working at 3 shifts, 24 hours a day to produce gold, and he still has a waiting list for customers. His problem is he can't find enough gold, whether it comes from minor or existing gold bars that aren't quite the quality the buyers want, and his contact is a senior veteran of gold markets who's been in their business for 35 years. His talk with his friend showed him the physical shortage of gold is already showing up. China has certainly contributed to that shortage. China is holding $1 trillion plus of U.S. treasuries and other debt, but the dollar has no greater friend. China wants a strong dollar. It wants a strong dollar because it's holding $1+ trillion worth of securities, and it doesn't want to see them lose its value. But China doesn't trust the United States, and it shouldn't. It knows the United States historically has devalued the currency through inflation to get out of any form of debt. So China is highly vulnerable to inflation because it's owned so many U.S. dollars denominated securities. Why doesn't China simply dump them? The answer isn't that they can't dump them. The U.S. Treasury market is not that deep. It's not very liquid. China can't dump the quantity of Treasury securities even if the market we have. And the president could actually stop them if he tried to. So the Chinese are stuck holding that paper. They want a stronger dollar but fear that we're going to inflate the dollar. And there's a problem right then above there. And since they can't dump the treasuries, they're buying gold as a hedge. If the dollar is steady, the securities retain their value. The gold may not even increase much. But if we inflate the dollar and it loses value, they'll lose on the paper side. But they'll make it up on the gold. The price of gold is going to soar, so they're trying to create a hedge position right now. Again, they prefer a strong dollar, but with the gold purchases, they're ready for a weak dollar as well. Jim Rickards also advises, from an investor standpoint, if it's going to be good for China, it also should be good for you. If you want to understand gold, it's fairly simple. If the dollar is going to get stronger, you might want to own gold. But if the dollar is going to get weaker, you definitely want gold. We've had a strong dollar since 2011. It's been a drag on the U.S. economy, harmed exports, and imported deflation from around the world. It's defeating the Fed's efforts to create inflation. These are all the consequences of a strong dollar. We couldn't have a strong dollar for much longer, and it looks like we're in for a weak dollar pretty soon. The trigger for a weaker dollar took place in last February in Shanghai, China in 2016. The global financial elites devised a plan to weaken the yuan without having China officially devalue its currency. Surprise devaluations by Beijing rocked global markets last August and this past January in 2016. To avoid that outcome, it was decided that the dollar had to be weakened. That lets China maintain its unofficial dollar peg while also creating a cheaper yuan to boost its economy. Essentially, the world's monetary authorities decided the U.S. and China can devalue relative to Europe and Japan. This could play out over years. Jim Rickards' outlook going forward is therefore for a weak dollar, and that means a higher dollar price of gold. That's one of the reasons gold has been performing so well over the last few quarters. It was the best performing asset class in 2016 and also the best performing asset class in the 21st century. Since 2000, gold has greatly outperformed every other asset you can think of, including major stock indexes and bonds. So in that sense, gold performs as an important insurance function. It's compared to fire insurance on a house. Nobody wants their house to burn down, but if it does burn down, you have fire insurance. Having that insurance was invaluable. It's the same with gold. If you have a 10% gold allocation, it's like owning fire insurance. If the stock market goes to all-time new highs and gold goes nowhere, that 10% allocation won't hurt you. But if the market collapses, which Jim Rickards does expect, and the price of gold skyrockets, that 10% allocation will increase by multitudes. That profit will protect you against losses in the rest of your portfolio. So gold has insurance functions, and that can't be downplayed.